Welcome back to America's Retirement Headquarters, home of the Retirement Guys formula at America's Medicare Associates with Nolan Baker. Really do appreciate you joining us today. 419-794-3030 is the phone number. The website is arhq.com. Inflation is something that we've been talking about for a good while now, and we often talk about increasing income in retirement to account for inflation. Ron Barron of Barron's Magazine looks to the stock market for that growth.
Everything doubles in price every 14 or 15 years. And the way you can hedge against that is you can invest in the market, which goes up about 10% a year. So the way I think about it is the investments that I have are investments for the long term in businesses where I think we're going to double our money. Instead of in 10 years, we're going to try to double our money every 5 years.
But I have to say, Nolan, trying to double your money every 5 years sounds like that would come with a lot of risk. Are there other solutions when it comes to keeping up with inflation?
Yeah, there really are. That's a pretty interesting comment that Ron Barron makes there. Really to double your money every 5 years, you need to make a 14.4% rate of return. That does seem pretty risky to me, although obviously, stocks are an area where it does have, some potential growth that's inside of there. And I certainly like stocks, but, for a lot of retirees, I will ask them the question at retirement time, are you more interested in doubling your money? Or are you more interested in not having your money cut in half? Because when you take those higher risks, that's sometimes the things that happen. But, inflation is certainly a topic that is biting into a lot of investors today. I mean, whether it's a younger investor, middle age, or a retiree, inflation, seems to be the real deal. If we look at the numbers, though, inflation's starting to get a little bit better. So you don't want to dramatically change your overall investment philosophy because inflation seems to be really high. So when we look at the annual inflation rate, the U.S. recently reported for the month of September, it was 3.7%. And that's according to the U.S. Labor Department. So where we see some of the biggest increases is dining out, that's up 6% year over year, transportation cost up 9.1% year over year, and shelter cost up 7.2%. So I know those are the bigger areas, and some people that are listening to the show would say, Nolan, inflation is absolutely a big bite into my pocket, and I would agree, especially when you're looking at dining out, transportation, and shelter. For the other areas, let's just say that when you add it all together, that the inflation rate is currently 3.7%. Here's what you want to do, and not dramatically change your overall investment strategy. What you want to do is you make sure that your investment dollars are working as hard as possible. In fact, if you're a retiree and you're not going to get up and go to work tomorrow, you need to make sure that your money is going to work every single day. So you want to look at the income that's produced, and you want to make sure that if you need income in retirement time, you're picking investments that are generating, more than 3.7% and or have the opportunity to generate more than 3.7%, or you could be going backwards. So here's some ideas on how to keep up with the higher inflation. First and foremost, if you look at high yield money market funds that are out there, there's a lot of different great investment companies that are very well known that offer high interest money market funds. And these high interest money market funds are now paying over 5%, here in November as I do the recording in 2023. So that would be a great idea if you have any lazy assets that are not earning greater than 5%. Look at some of the high yield money funds that are out there. The next is consider FDIC insured bank CDs. These are ones that are backed by the full faith and pledge of the United States government. Most bank CDs, if you look in that 1 to 3 year time frame, you can get 5.5% to 5.7% interest, again, higher than what the inflation rate is right now. Fixed annuities are what the insurance companies of America offer as an alternative to other traditional fixed investments. And with a fixed annuity, you can purchase a time frame from anywhere from, say, 1 to 10 years, and you can lock in interest that's 5%, ranging all the way to 6%, again, dependent upon the time frame of when you lock in those type of investments. Bonus annuities, these insurance companies are offering bonuses to people who set up an account for them, and I have seen bonuses in the insurance company be some of the highest that I've seen probably in the last 20 years, so since my kids have been born. So if you need a big jump start right away on your contract, a bonus index annuity can be a solution to help you fight off inflation if it's eating away at your dollars right now. Treasury inflation protected securities, still one of the biggest watched video on our YouTube channel with now over 4,000 views, is how to set up an account with the U.S. Treasury Department, walking through the interest rate that you can get on government-backed I-bonds. You could have number 6, stocks, as Mr. Barron talked about. But in this case, I would say, maybe even considering dividend-paying stocks, so stocks that generate consistent income, because as we know, stocks may double in the next 5 years, but they may also go down in the next 5 years. But if you need income in dividend-paying stocks tend to be more consistent than what the stock price is. There's also things that are called real estate investment trust. And, when you look at real estate investment trust, you have both public and private REITs that are out there. You've got to watch out, I'd say, in some of these companies that have large amounts of debt because of a refinance issue with interest rates being higher. Some of these REIT companies might own a lot of debt and it's locked into lower rates, but that rate may reset in a year or two from now, and that could be a challenge for some of these real estate companies that have high debt, but it could be an income option for somebody in retirement. Commodities, it's a popular topic, when people are worried about the U.S. dollar, to talk about gold and silver and or energy investments. And, the last category is high-yield bonds. As interest rates have gone up, if and when interest rates stop going up and at some point interest rates level off, bonds could become a little bit more attractive. So, again, the solution here is, if you're worried about inflation eroding your purchasing power, it's important to make sure every dollar that you have is working. And our independent portfolio analysis can help you determine, which investments that you may want to look at some alternatives to try to drive up some of the income and try to work towards getting a pay increase. And again, we'd be happy to do that. If you just reach out to us, we give you an independent portfolio analysis looking for ways to how to increase your income that can keep up with inflation.
Because here's the truth of the matter, even aside from these high inflationary times that we've been in for the past couple of years, inflation is always going to be a factor. The buying power of your dollar over the course of a 20, 30-year retirement is going to diminish. So you do need growth in your portfolio, even in retirement, and making sure that, you have your money growing, perhaps aside from the market, using any of these strategies. It all starts with having the independent portfolio analysis run, figure out what's going to work best for you. Just give a call, 419-794-3030, and ask for that independent portfolio analysis when you reach out, 419-794-3030, or go to the website, arhq.com.